Hey, good morning, YouTube. Today we're going to talk about some returns of stocks versus real estate and see which one is better, and talk about a couple differences between the two and how one can set you up for the other one. So let's get started. Here's kind of a return analysis of three different house purchases: VIG, which is a broad market index fund, and Home Depot stock. And this is kind of starting with the framework of 2012 to current, so a 12-year return. And as you can see, the stocks, these two are about 12 years from the house standpoint. This one is about 5 years, so you can see the cost is higher. I'm going to put 5 years here. And they both are 12 years stock returns. So you can see this was a little more cost, this was a little more cost. The investments here were lower. This one was probably 50% investment. This fifth one was one of the points I want to make, which is the fifth one in the low down payment here. The low capital in was enabled by the first house, and so there's some kind of a building skill sets and capital in real estate that you don't have the same effect in the stock market. So here's your investments at Home Depot, and individual stock would perform great, and VIG, which is just an index fund, has a bunch of stocks in it that pay a dividend. And so here's the yearly cash flow on each one of these investments currently. As you can see, after 12 years, the house cash flows very well, $7,300 with this profit, and there's no principal payment on that, any debt there. This one has the cash flow, which is small, and there's principal payment, so yearly profit is actually higher than the cash flow on that one. And this one, you can see, after 5 years, this house in this year is negative cash flow based on the payments compared to the interest rate and the things that's paying, and barely positive profit. And so we'll see how these play out and what occurs. So yearly total capital return over this time period, this is the 12-year period, 572%. And what that is difference between here and here divided by this original investment, which includes the fix-up did on the property. This one obviously is much higher. I really didn't put any money in it when I bought it, and I fixed it up, and that's the only really interest investment I had. Those were 3,900%. House number 5 has been 5 years, 35,000 in. This was 25,000 for cash in and 10,000 to the fix up. Total return in 5 years, 428%. 237%. This is the 12-year return on the index fund. This is the 12-year return on VIG. And if you take those capitals and you convert those into individual per year average returns on this valuation, here's what it looks like across those. And back over here, this shows you the yearly profit, which is the profit number here divided by the initial investment. So these are the numbers, and obviously this one is very high because the initial investment is only $5,000 and the profit is making it that much per year. But a lot of that is going into principal payment, so it's not cash flow, but it is profit. So total yearly return, if you just take the per year average capital return over 12 or 5 years, depending on the investment, and then you add in the current return on the profit, not the cash flow. For each investment, you got first this house, it's just 36% per year. This house, 163. Now again, this is because we only put 5,000 down, and it really revs it up. How do we only put 5,000 down? Well, because we had houses before that could be sources of capital. House number 10, 5 years. This is what we're doing today. Now, as you can see, the cash flow in that house right now is negative, so you are putting money into the house, but net after this 40% average on 5-year return, you're still making 40% on the money. VIG 18%, the kind of the lowest return on it. Cash payout, if you've done it for 12 years, right now, based on the original investment, it's 5.77%. Now, originally, that's like 1.5%, but that's increased over time as the valuation has gone up and the dividend has increased. Home Depot, 14.5% dividend over the time period was what you're getting right now, and increased capital value 18% per year, so 32.52. So, as you can see, this is actually what happens in real estate and stocks, and leverage can massively increase your investment output. Sometimes initially, in some years, depending on the interest rate, your cash flow can go negative. Now, how do you cover a negative cash flow? The best way to cover it is to look at this all the way across your portfolio and say, okay, it was $15,869 if this is what your portfolio looked like. And so this house is great cash flow, not as great capital improvement. This house is better capital improvement, not as great cash flow. This house had the highest capital improvement, but the cash flow is negative. So what I look at is, how does this affect my net worth each year? And from that standpoint, cash flow does not matter, because cash flow is reflecting the shift of your money into paying off debt, which doesn't really change your net worth. Yearly profit is really what you're concerned with. So the yearly profit on, if you had all these things, would be $26,351 plus increase in value across that time period on those assets. That's the real thing that happens. And depending on how the market's happening with inflation and expenses, this profit and cash flow might follow this increase in value by a year or 2 years or 5 years. Eventually it's going to follow it, unless there's a tremendous market shift in how houses or stocks are valued. And so really I'm looking for this valuation to increase, and how can I maximize that, and then make sure the cash flow works on a monthly, yearly basis, and focus on how to increase the profit so that I'm dropping money, increasing that. So these two things add to how much my net worth is increasing. And I wanted to share that with you. I saw a video from somebody today talking about which one's better, real estate or stocks. I will say a couple things in addition, that it is difficult to buy stocks at an advantageous price, meaning most people buy when they're high and sell when they're low. That's why they're high and low. And you might think you're smarter than most people, but I would say that don't count on that. And as far as stocks, houses, when you acquire a skill set to figure out the house and find the deal and some things like that, you can apply those to buy those at below. Now these were below market values when I was buying them, and so you can apply it to buy them below market value, which helps accelerate your return. Once you get a certain number together, then you're out of pocket. Your investment in those new houses changes and decreases significantly, and so this can grow exponentially because of those factors. And this requires new investment constantly as you're building that over time. And I just wanted to share it with you today. For what it's worth, over time, things that are assets and pay you a trickle that you can buy at an advantageous price are really going to raise your net worth and your security. Those things are going to maintain their value as the dollar decreases in value. And so if you look back at here, part of this 5-year massive increase here was 2019 to 2024. And that inflation, just ramping it up, and we probably had a good 60-70% inflation across that time period. And that means that the house is going to maintain its value as the dollar goes down, and that's going to look like this fantastic return. Because you only put $35,000 in, the other part you're carrying with debt somewhere, and so that debt will go down legitimately in value as inflation happens, and that actually makes you money on the back end. So you're making quite a bit here on inflation. You're actually profiting from inflation and not so much from the value of the house increasing. Although this one and this one did because of a demand increase. This one there's a small increase. Most of this I think from here to here is inflation. The dollars went down in value. It's good to know how you're making your money, but that's kind of the comparison I would draw. One of the other advantages in stocks is that they're taxed more beneficially ultimately if you don't pass them on to your heirs, if you actually sell them. And real estate has advantages of taxes along the way because you get to depreciate them over a period of time, which gives you more cash to do more investments. And additionally, houses you can do 1031 exchanges, and you really can't do that with stocks, and so you can sell one and roll it into another asset, maybe that's a better deal or something. And I will say that lastly, the thing you need to be most aware of is that if you buy a house, you can't instantly sell it. And people might say that's a disadvantage, but I would say that's an advantage because most of the time people are selling stocks when they're low and buying them again when they're high. And so with houses, you can't instantly sell it. It takes time. And so that kind of forces you to be in that investment for a longer period of time, which allows you to see the results, and those results encourage you to continue in that investment. So behaviorally, houses are definitely easier to build wealth in than stocks. But it would seem the opposite from the numbers, but I would say definitely not unless the money's in your 401k where you can't touch it so much. But hope it's valuable for you. Take some action. Don't take a big action. Don't worry about how big what you do is, but just do something to get your momentum kind of started with what you're trying to do. I'll talk to you later. Bye.